Dr. Babasaheb Ambedkar Open University.
Hello friends, welcome again in the course of a Fundamental of Financial Accounting. As we are discussing in the last few lectures all subsidiary books. Before that we were discussing about the journal entries. Now here I just want to tell you what are the difference between the journal entries and journal proper. See, when you are preparing a subsidiary books like purchase books, sales books, cash book, bank book or petty case book and so on. So ultimately the remaining transactions which are not recorded in the purchase books and cash books and bank book, all the remaining transactions will be recorded in the journal proper. So that we need to identify that the transactions which are actually excluded in the subsidiary book or transactions which are not recorded in subsidiary book, all transactions will be recorded here in the journal proper. So journal proper, it means the transactions which are remaining, then the record of the transactions in the subsidiary book are going to record in the journal proper. So let us see what are the key takeaways in this particular chapter. What is journal proper? So how this is actually showing the importance to record the transactions, then the features of the journal proper, then what is the format of journal proper. The format of journal proper, it's almost like a similar of a journal entries, that's a similar kind of a format. Then we'll have to discuss the important transactions to be recorded in journal proper. What are the importance and benefits of this journal proper, and then the limitations of the journal proper. So at least we can get an idea that how this journal proper would be helpful to us to identify the transactions and recording the transactions, and maybe there are some limitations. Then what are the limitations also we will discuss, and at last we will discuss the illustration. Some transactions will just have a entry to record in the journal proper, so you will be able to understand that how this transactions recorded in the journal proper book. What is journal proper all about? Journal proper, as I mentioned, that all the remaining transactions which are not recorded in the subsidiary books are recorded in the journal, that is called the journal proper. So this is journal proper, the all miscellaneous journal, the book of original entry used to record the transactions that cannot be entered in any of the subsidiary book. So the transactions which are not recorded in subsidiary books to be recorded here in the journal proper. It is the routine cash and credit transactions go to cash books, that we know. Purchase and sales transactions which are credit transactions, credit purchase and credit sales are recorded in purchase and sales register or purchase and sales books. Non-routine or residual transactions are placed here in the journal proper. All right. Journal proper entries, it's very clear, the total business transactions, that means all business transactions minus the special subsidiary books. Special subsidiary books like purchase book, sales book, goods return books, cash book, bank book, etc. All this subsidiary books transactions will be deducted from the total business transactions. The remaining transactions will be recorded in the journal proper. Okay. Features of journal proper. First is book of primary entry. It's very simple. Like earlier also, the whatever the economic transactions takes place, all economic transactions need to be identified where to record. Suppose if it is identified that it will be recorded in purchase book, or maybe a sales book, or maybe a cash transaction, cash book, or bank transactions, bank book. If you identify that these transactions will not be recorded in any of the subsidiary book, then it will be a first entered in this journal proper. So book of primary entry, transactions are recorded chronologically for the very first time. So this is also a journal entry only, but it is recorded first time in this journal proper. Then the residual nature act is very clear, that is act as a catchment book and non-standard transactions. Non-standard transactions, why it is non-standard transaction? Because of it's not a purchase transaction or a sales transaction or specific transaction. So all these transactions are to be recorded here in this particular journal proper. Double entry compliance, each transactions have a same kind of effect, one debit and other one is credit. So each transactions have twofold effects, one is debit, other one is credit. So debit and credit, same rules for each single entry or a single transaction. mandatory narration that you have to write it, accompanied by the concise explanations explaining the transactions background. We need to understand the narration is mandatory. So suppose if you purchase a machinery and that machinery purchase on a credit basis, then we'll have to write that the machinery account debited to from whom actually we purchased the machinery, the person's name has to be credited. Then we'll have to write the narration that being the machinery purchased from the so and so vendor on a credit basis. So that narration has to be written there. Suppose some expenses are outstanding, we have to pay the expenses. Suppose rent is outstanding, then rent account debited to outstanding rent account. We have to write the narration being the rent to be paid on a building or any kind of offices or any it's outstanding. So that is the narration. It's mandatory to write the narration. Ledger transfer entries are recorded here, has to be recorded in the ledger book, and it has to be posted. So that is the baseline to post all the particular transactions into the respected ledger account. Alright, so now we'll have to see the format of journal proper. As I mentioned you, journal proper and journal book both are same, only the name is it is journal proper. Why it's journal proper? Because of we are preparing after the subsidiary books this journal. So it is prepared parallelly. So but those transactions, when you are preparing a subsidiary book, then you need to prepare journal proper. If you are not preparing a subsidiary book, then only the journal book is preparing, and all transactions will be recorded in the journal book. But here because of the subsidiary book, we are preparing a journal proper. First is written date, on which date the transactions takes place. Then we'll have to write the particulars. If you are purchasing a furniture and furniture purchase on a credit basis, so then instead of the purchase account, we'll have to write here to the vendor account, the whoever's vendor's names are there. So furniture comes in furniture account debit, and it was purchases on a credit basis. The vendors are giver, so vendor's account will be credited. LF, wherever this transactions actually posted, that the posted on which particular ledger folio number, that we have to write. Suppose the furniture account is prepared on the ledger folio number 10, then it has to be written 10. If the vendor's account is prepared on the page number 12, then it has to be written here 12. So amount of debit and credit will be written there according to the understanding. So this is the way to write the journal entry. Explanation is already here, which are already explained. Now moving key transactions, these are the very important point. Journal proper, when you are preparing a journal proper, there are certain transactions. I am taking some examples for you to explain. So just you try to understand the logic of each transactions, how to record in journal proper, correct? So any kind of other transactions other than the explanation here, that also you once you your logic will be clear, you will able to understand how to record the other transaction also. Now first is opening entry. So any balances which is brought forward in this account, or then it has to be forwarded to the balance sheet or somewhere, then how the balance sheet will be forwarded here? The very simple way, assets are debit. So assets account is debit. Here the balance, opening balance is going to written here. So in the new accounting year. So all assets account will be debited, capital is always credited, and liabilities are always credited. So assets account debit, liabilities credit, and capital credit. So this is an opening entry, all bringing forward assets and liabilities balances at the start of new accounting year. Now closing entry, how the closing entry will be given, or at the end of the year all these accounts will be closed down and transferring into the other accounts. Or maybe suppose if you are going to close those accounts of assets, then assets will be credited, liabilities will be debited, and the capital will be debited when you are closing the accounts. But here this opening entries, now closing the accounts, which one? Suppose sales we are transferring into the trading account or in a profit and loss account, or you prepared combined revenue account or something like that, the sales generally credit. But when you are actually closing down the sales account and transferring into the revenue account, so sales will be debited, and the trading account, or maybe if you are preparing a P&L account, or if you are preparing a combined revenue account or something like that, the sales account debit to trading account and P&L account and whatsoever, wherever you are transferring sales account. Suppose if you are closing the purchase account, the purchase is debit, but you are transferring into a trading account, so trading account debit to purchase account. This is the closing entry of the transaction. Now third is adjustment entry. That is also very important. Any adjustments are there, that adjustment means those transactions which are actually unrecorded in the books of accounts. Even though it is a business transaction, but due to a certain reasons, these transactions were actually left out to record in the books of accounts. So now these transactions will comes into the books of accounts through the adjustments. So now what is adjustments? Suppose in corporation it's maybe some transactions unrecorded accrued items like outstanding expenses or a prepaid incomes. Then what to do? Suppose outstanding expenses like a salary. The salary was actually supposed to be paid, but by mistake it was actually not paid. So that is outstanding. So salary is an expense, salary account debited. Outstanding salary is your liability. So outstanding salary account is credit. So income received in advance, that means the received income in advance, it's your debit because of it's the part of an asset. So received income, it's consider it's a part of a received income in advance debited to income account. So income account will be considered it's part of. But suppose if it is received in advance, then it has to be deducted from the income. So the received income in advance, income account debited, and received income in advance account credited. So because of the received income in advance, it's your liability and it has to be deducted from the income because of it's not a current year income. So income account will be debited. Moving to the next part, that is fine. The another transaction is transfer entries. When you are actually transferring some transactions like commission or maybe any other expenses are there where you are transferring. So those items which are transferring to the certain account, the existing items account will be debited and the transferring amount will be considered. So here the commission is your income where the commission is received, but the commission is actually your income because of it's a credit. But now here the closing the commission account, so that's why the commission is debit and it is transferred to the profit and loss account credit side because of your income. So commission officially when you are receive commission, it's your income, so it should be considered as an income. That's why the profit and loss account is credit, and commission is account is going to close it. That's why the commission account is debited. Rectification entries, maybe certain transactions which are actually recorded in the books of accounts by mistake, it's reverse entry or maybe a wrongly recorded with the amount or maybe wrongly recorded with the debit or credit or anything. So that has to be rectified. So errors and rectifications. Errors committed in accounting records are corrected through the rectification entries. So maybe suppose if you are consider here the furniture is your purchasing, but by mistake if you are recording furniture purchase instead of the furniture you recorded as a purchase. So we know that if you consider a furniture as a goods, then the purchase is right. But suppose if you are not doing a transactions of furniture, it's your regular goods, then furniture should be treated as a furniture rather than the purchases. So if you are recorded as a purchases, then it has to be rectified. So what we have to do it? We have to write the correct entry. So furniture purchase, that's why the furniture account is debited. Purchase were wrong, so purchase has to be credited. So here the rectification is furniture account is officially debited because of it's a right, and purchase were wrong, so it has to be credited. So now the purchase will be nullified. That's why the purchase account is credited. Next is depreciation entries. Depreciation is always charged on your assets. The depreciation should be debited. So that's why the depreciation account debited, and when you charge the depreciation on assets account will be credited. Here the machinery is credited, maybe depreciation charge on building, machinery, furniture, equipments, etc. All assets account will be credited. Moving to the next item. Yes. Now importance and benefits. What are the importance and benefits of the general proper? First is it's a complete accounting. So ensure that the non-routine and unusual business transaction should be left. So if it is left or unrecorded, that we have to find out the transaction should be recorded in general proper. So then it will be easily managed for the audit. So 100% audit trail can be identified through the general proper. So those transactions which are actually non-routine and unusual business transactions has to be recorded in general proper so that audit can be easily completed. Accurate statements facilitates accurate year-ended adjustments and closing entries to be done. So that's why the true financial reporting and financial pictures can be identified. Why? Because of say certain period of time, maybe when you are recording a certain entries, okay, the entries are recorded in the books of accounts as per the understanding, but few transactions you were actually left out because of the transfer entries or closing entries, and due to that closing entries and transfer entries were actually your financial positions were not showing a clear picture. So that's why when you are actually doing an accurate statements, you need to complete all the entries recorded in the books of accounts systematically. Error and rectifications, when you are actually identified those transactions which are unusual, or maybe naturally that unusual transactions, or maybe it's considered a non-routine transactions, it has to be find out that all the transactions have a minimum double entry for the transactions. One transaction is debit and other one is credit, and as per this mechanism it has to be recorded in the books of accounts, so that you can actually rectify your errors if any errors are there. So this is the way this would be benefit for us. Limitation of general proper, it records only occasional transactions. It is considered a limitations. Why it's considered a limitation? Because of many times the people might forget that these transactions will be recorded whether in subsidiary books or in a general proper, or maybe due to the confusions that maybe the accountant assume, if the separate accountant persons has been appointed, that some people may be prepared only purchase and sales book, some people may be prepared only cash book and bank book, and other person is prepared only general proper, then the one person may be identified that these transactions were recorded by the other one, or maybe A or a B or C. So that's why due to these confusions, maybe the transactions might not be properly recorded in general book. That quite possible. Another one is improper recording may affect the final accounts. If we are recording wrongly, then also again it's creating a problem, because of maybe suppose if first is credit transactions, then half cash transactions, maybe half cash and half credit transactions. So how these are creating a confusions that where it should be recorded first, how much will be recorded in which particular book. So these are the confusions to consider to record the transaction in the books. Require knowledge of accounting principles and journal entries. That is anyway it's required. If you are preparing simple journal book also, this accounting principle and journal entries knowledge, rules and regulation should be knowing. That's why that is the minimum requirement. It's a limitation for both the ways, not only general proper, it is a limitation for general and subsidiary book also. Errors in the general proper may lead to incorrect financial statements, correct? So any kind of entries recorded in the general proper wrongly, definitely any transactions recorded wrongly in general proper, the financial statement may be not prepared properly, or that creates an actually errors with the certain transaction. So need to identify where the errors takes place. It is also very difficult when you are actually recording a multi books, right? So this is also a very kind limitation so far is concerned. Now this is the general proper example. So I'll give you a few examples how to record these transactions in the general proper book. So here Mr. Amit started his business on 1st April 2026. During the year, following transactions takes place. So we are preparing a general proper in the books of Amit. So we are preparing here general books proper in the books of Amit. Second is salary outstanding at the end of year 5,000. So outstanding salary, it's an expense. So salary is an expense, salary account debit, and outstanding salary, it's your liability. So salary account debit to outstanding salary account 5,000 rupees. Then insurance paid in advance. Expense is paid in advance. That means it is your receivables. So insurance paid in advance, that means actually insurance account is debited. Right. So insurance account is debited, expense is debited, but here you paid in advance, so insurance account should be credit. We have to deduct it from the insurance, and it is paid in advance, that means it's your receivables. So insurance paid in advance account, it's debit, or a prepaid insurance account debit to insurance account credit. Next is depreciation on furniture. Depreciation on furniture, depreciation is an expense. It's a non-cash expense, but it's an expense. So depreciation account debit to furniture account. Next is goods worth rupees 4,000 withdrawn by proprietor for personal use. Goods of rupees 4,000 withdrawn by the proprietor for personal use. It's a drawings, right? So ultimately it's not a sale. That's why it's not recorded in purchase book. Withdrawn, and it is actually not to be recorded. There is no cash transaction also. So that's why it's recorded in general proper drawings account 4,000 debit, and it's considered maybe purchase, or you can write here goods withdrawn for personal use. You can write another way also, goods withdrawn for personal use. Next is bad debts of rupees 3,000 write off. Bad debts is again non-cash item. Bad debts is actually creating that those debtors which are unable to pay the amount of their outstanding, it's converted into a bad debts. So bad debt is an expense. Bad debts account debited to debtors account. So here bad debts account is debit and debtors account is credit, because of the debtors actually or assets, current assets, but debtors are unable to pay. So that's why the debtors account is credit, and bad debts is your expense debited in profit and loss account. So that's why the bad debts account is debit. Provision for doubtful debts created 2,000. Provision for doubtful debts, it's a reserve, and reserve against the doubtful debts always created from the profit. So it is created from the P&L account. So that means the P&L account has to be debited because of this reserve created from the P&L against the some amount of doubtful debts might be created in the future. That's why we are creating a reserve. So the P&L account debit to provision for doubtful debts is credit, because the provision for doubtful debts is a reserve. So P&L account debit to provision for doubtful debts account. Next is interest on capital allowed 6,000. Interest on capital, again it's an expense per P&L account or a P&L appropriation account. So interest on capital account debited, and this interest on capital will be credit to capital account. So interest on capital account debit to capital account. The last is furniture purchase for 15,000 were wrongly debited to the purchase account and later rectified. See, in previous slides we just try to understand the wrongly entered recorded transactions. We have to rectify it, errors and rectifications. Here this transactions were actually wrongly recorded in the books. Actually purchase furniture, but it was recorded in the purchase account. So what they did actually, they were debited purchase account to cash or to bank, or purchase account to the vendor's account or anything. Ultimately the cash we don't want to consider here, whether it's a cash transaction or credit transaction. It's not a material. Material is what? The transactions were wrongly recorded. So we need to rectify it. So only rectification entry is required. The HOP entry was correct, whether the cash payment or a bank payment or an outstanding through the vendors or whatsoever, it's correct. What was wrong? Wrong was purchase account debit. Actually it's not a purchase account, because of they were not doing a business of furniture, right? So it has to be debited on the respected assets. The assets is furniture. So what we have to do it? The wrongly entered transactions, we have to rectify it and reverse, and correct entries has to be debited. So correct is furniture, so it is debited furniture account. Furniture account should be debit, and purchase were debited, which is rectified. So to purchase account will be credited. So this is the way to record the transactions rectified in this particular. So furniture account debited to purchase account. So this is the way to record the general proper books. I think you might understand how the subsidiary book is prepared. When you are preparing a subsidiary book, then the remaining transactions will be recorded in general proper, and how this transactions rectified to record in the general proper. I hope you are understanding all these transactions recorded in a basic books. Now we'll moving further next lecture onwards to understand the another book. You have to practice more in this all the particular different kind of books and different kind of transactions to understand properly, so that we will actually try to more studies in the coming next lectures to understand another book also. Thank you so much.